Let's talk a bit more about the markets, how political change may impact the outlook, and the role that retail is playing within this market. Joining us for that conversation is Brian Nick. He's the Chief Investment Strategist over at Nuveen. We're also joined by Amy Wu Silverman, Equity Derivatives Strategist over at RBC Capital Markets. Amy, I'd love to start with you and something you flag in your note, which is an area of the market I've been so interested in, I think we all have over the last 6 months, which is the role retail has played and sort of how real that is as a part of the market setup today, and sort of how that maybe shapes the way you're thinking about markets as we get into 2021.
Yeah, it's become a really interesting topic, and I will tell you that one of the most unexpected things for us in the derivatives market in 2020 was just how much retail exuberance we saw, how much we saw retail come into the options market and buy calls and just become more savvy and involved in the market. And I think to some degree this is probably a general sea change as you get Robinhood on your phone and zero commissions. And one thing it is doing to our markets is it's really taking these historical relationships that we have come to count on and disrupting them. So options skew, for example, where the put implied volatility is typically higher than the call. We've seen that inverted in a lot of names, and it continues to be so. It hasn't normalized in a lot of them. And so I think we watch those metrics closely. We continue to see volumes make highs on call option contracts. And, we're curious how that comes in the next month as well.
So, Brian, let me bring you in on this notion as well, because I know that you, like many investors, are watching politics closely. And I wonder if, in your experience, retail investors react differently to those political changes than do institutional investors. And how are you sort of factoring all of this in as you're making strategy?
Yeah, they absolutely do. In fact, the first time all year last year that we finally saw a net inflow into mutual funds and ETFs on the part of retail investors was after the election. So there was clearly some thinking, whether it was political or not, or maybe just waiting for a risk event to pass, that they didn't want to be invested until the election. And then I think subsequently the vaccines being announced and improved was also a big deal. You also see a lot of split among consumer confidence surveys, among the types of investors who are willing to engage based on political parties. So there is certainly some politics embedded in retail flows, but we're still seeing net outflows from equity mutual funds, equity ETF. So there's this, I think, this sense in which the buy and hold investor has not fully re-engaged. They may be more confident about the outlook from here on in, as are we, but they are not yet fully engaging or even returning to the net holdings that they had, say, this time last year.
Amy, one area where the retail investor is still staying focused right now, it is megacap tech. I mean, stocks have not necessarily started off too well this year, but they remained some of the most owned stocks in the entire market. How do you trade FANG stocks right now?
Yeah, FANG stocks are interesting because what you decide to do with FANG stocks and FANG man stocks is ultimately, to some degree what you want to do with the market. It continues to be 50% of Qs, 25% of the overall S&P. This sounds a little counterintuitive, but one trade I actually like right now is selling calls on long positions you own in FANG and FANG man. And part of the reason is after the Capitol riots, tech really became part of this overall conversation that we've already been having about regulation, but it really became front and center with what you saw in Twitter, Facebook, et cetera. I think retail continues to love and own these names. These are obviously the new blue chip companies, but at the same time, you do have large institutions concerned about what regulation and potential breakup means. And so you really have a good environment where volatility tends to continue to be high, especially with the pandemic still ongoing. And you can retain a lot of upside in selling yield in these companies. So, you're getting 5 to 6% for 3 months on high volatility on names where you're still retaining 20 to 30% upside in a world where there's very, very little yield.
And, Brian, related to that big cap trade is what we've seen on the reflation side. I know that's an area that you're looking at. It seems like we talk about inflation every day here on the program. I think we all have reason to be skeptical that it's going to really show up. But certainly that's an area that investors have gotten interested in. It's certainly been a big part of the conversation early this year.
Oh, absolutely. It's the most common question we get. Sometimes it relates to the debt. Sometimes it relates to what the Fed is up to, or the kind of the cross section of the two. I think, as we'll probably hear about this morning on Capitol Hill with Janet Yellen's confirmation hearing. No question, investors are looking to get hedges away from inflation. A lot of the times, I think what they're really looking for is a hedge against rising inflation expectations. You can do that through owning tips. We think real assets can be a component to that, as well as inflation, whether actual or forecasted rises. Things that have a kind of a real store of value tend to outperform. But the equity market should do fine in a modestly inflationary environment. I think that's all we're going to get this year. We'll probably get a spike in inflation over the spring months because of base effects. I think we don't want to pay too much attention to that because the Fed certainly isn't going to care that much and start to raise interest rates in anticipation of much higher inflation. But there is going to be that spike as last March and last April roll off, and that could get even more attention to the issue of inflation. There's so much slack still in the U.S. economy. We have a 6.7% unemployment rate. That's almost double where we were a year ago, and we weren't getting inflation a year ago either. So the notion that we're about to get this sort of huge uptick in wages that feeds through into price increases, I think we're a few years away from that.
Brian, I want to ask you to pull out your calculator on an Apple Watch right now to calculate this, but our Sam Rowe wrote in our morning brief newsletter this morning that the stock market could double by 2040. That's really essentially almost 10 years from the worst of the health pandemic. Is that realistic? I would even make the argument, do you think that's conservative? Look where companies are going to come out of the pandemic, much more lean, much more efficient. And to me, that really gets a setup here for some really powerful earnings gains, at least for the next 10 years.
I think that's probably right with respect to earnings. I think we're going to see the ability of companies to become even more productive. I think some legislation that we could see this year, especially later in the year with respect to public investment infrastructure, could also help with some of that. I don't think the market is valued to take off in terms of price increases at any kind of a historic rate over the next 10 years. The best predictor of what the market does over a 10-year period is how it's valued today. So if you're looking at things like cyclically adjusted PE, 12-month forward PE, these are all extremely high relative to normal or average. And so over the last 10 years, investors have earned about 15% per year owning the S&P 500 on average. I think over the next 10 years, we'd be lucky to see half that. And now 7.5% returns per year is not a disaster by any means, but investors who are assuming that the last 10 years are going to look like the next 10, I think have to look at where things were valued 10 years ago versus today. We may be in good shape in terms of earnings outlook, but I think that is probably incorporated into a lot of the prices of at least of the larger cap stocks that we see.
So, Amy, on that note, I want to bring you back to the idea of retail participation in this market, and whether, particularly when we're talking about options, whether retail investors know and understand what they are doing, as we see, extremely high open interest here on the part of retail investors, and the implications for that for the long-term ability of the market to continue to rally, as Brian and Brian were just discussing.
Yeah, it's a good question, and there's twofold. One is there are now these forums where people can kind of discuss options, discuss derivatives, and some of the things that have been discussed have surprised me in terms of the level of savviness. So, for instance, talking about a gamma squeeze, which is a technical dynamic that happens to a dealer in certain situations on options. That's something where I've been doing this for 17 years and, has usually been relatively niche. And you're actually seeing this in a broader forum being discussed. So I find that overall interesting. But the second part is, there is a distinction to be made between a lot of the activity we're seeing right now, specifically from retail, is in smaller cap names. It's also in smaller dollar names, and some of it is in, off exchange or digital assets. And so what actually happens, because the overall stock markets like S&P and the NASDAQ are so heavily weighted, as we discussed before, to FANG and FANGMAN, is it is actually possible to continue to have retail exuberance at the same time that indices like those continue to face headwinds, because the market meat has become so much of these handful of companies, so that you can continue to have retail call buying on these smaller names and still see maybe the overall indices kind of sell off a little, like we saw last week.
Yeah, and Amy, I think that just speaks to the structure of the market has changed in ways that we're only beginning to kind of grasp and see as we kind of get through this next cycle. Been a really fascinating time, and I know that trend will continue as we go forward. Amy Wu Silverman with RBC Capital Markets, Brian Nick with Nuveen. Thank you both so much for joining the show this morning.